If you're into spotting low-profile, high-quality companies before the market catches up, welcome to Insightful Value. Today's deep dive is into Jack Henry Associates, a fintech stock that's been quietly slipping while its fundamentals remain surprisingly resilient. The share price is down, but is the story really negative? This review is for informational and educational purposes only, not financial advice. Be sure to like the video and subscribe to the channel if you're into data-backed investing without the noise. Jack Henry Associates is not your typical high-growth fintech name, but it's been a steady operator for decades. The company provides core processing and digital banking software primarily to small and mid-sized financial institutions across the United States. While the headlines are dominated by flashy startups and big bank tech, Jack Henry is the reliable engine behind thousands of community banks and credit unions. Their software is mission-critical and sticky. Switching costs are high, and customer retention rates are excellent. From a value investor's lens, Jack Henry is interesting because it combines stable recurring revenue with conservative financial management. The stock has pulled back recently, primarily due to short-term earnings pressure, a slight slowdown in digital banking adoption, and investor rotation out of lower-growth tech. But the fundamentals remain attractive. The company posted around 7% annual revenue growth in the latest fiscal year, with solid operating margins near 22%. While not explosive, it's consistent and predictable, hallmarks of a compounder. Recent earnings came in slightly below market expectations, mostly due to increased investment in research and development and cloud infrastructure. While that hit near-term profitability, it strengthens the long-term outlook. Jack Henry is transitioning more clients to its cloud-based platform, which should boost margins over time and improve scalability. This is not a company sitting still, it is modernizing, but doing it methodically and without burning capital. On the dividend side, Jack Henry has paid uninterrupted dividends since the 1990s and has been raising them annually for 30 years. The current yield sits around 1.4%, which is modest, but the payout ratio is below 50%, allowing for continued dividend growth. For conservative investors, this adds a layer of reliability and a shareholder-friendly culture. Risks include its concentrated focus on the U.S. financial services sector. If small banks struggle due to consolidation or economic downturns, Jack Henry could feel the pressure. Additionally, competition from larger fintech players and aggressive startups could limit growth. That said, Jack Henry's long-term contracts, strong client relationships, and conservative balance sheet help mitigate these risks. Why might now be a good time to watch Jack Henry? Because it is a rare combination of quality, consistency, and undervaluation. The stock is trading at a discount to its historical averages on earnings and free cash flow, which doesn't happen often. If you're looking for stability rather than moonshots, this is the type of company that deserves a spot on your radar. Could the stock recover soon? That depends on how quickly the market starts valuing steady compounders again. As interest in flashy tech cools, companies like Jack Henry could come back into favor. It is not for thrill seekers, but for those who value patience and predictability. At Insightful Value, we uncover companies that may not be hyped, but are built to last. We make the data simple, strip out the buzzwords, and focus on what really matters. For more analysis like this, visit insightfulvalue.com. If this breakdown helped you see Jack Henry in a new light, hit like, subscribe to the channel, and don't forget to explore more in-depth reviews at insightfulvalue.com.